Ladies and gentlemen, welcome to the Closing Time Podcast. I am here with Ariana Graves and Tessa Johns, and today we're going to be busting some mortgage myths. Now, before we get into this, I do just want to state that all these myths are in general, right? Mm-hmm. Every situation is going to be different, so you really want to talk to a professional that can guide you with your specific situation. And one myth we're going to bust right out of the gate is it does not affect your credit score to have a pre-approval consultation. Everything can be done on a soft inquiry. We can give you a good roadmap or game plan on what you need to do to get pre-approved. But there are situations where you can get a full pre-approval without even doing a hard inquiry to impact your credit until you go into contract.
Absolutely. I love that.
It's also free. So if you have 15 to 20 minutes of your time that you're willing to commit, there's no other drawbacks.
And the only bad side is I've told the same jokes for like 10 years during all those meetings. So you got to hear the same ones all of the time. So real quick before we jump in, I want to give each of you a chance to introduce yourselves and tell a little bit about. So Ariana, go ahead.
Awesome. I'm Ariana Graves. I'm with NFM, and I've been in the mortgage space for about 6 years now. I absolutely love educating people on building wealth through home ownership. And yeah, I'm excited to be here.
Awesome. Thank you. And then?
Yeah, my name is Tessa Johns. I am also a loan officer here in Central Ohio. I have also been in the mortgage industry for coming up on 6 years here. And I particularly have a passion and love for helping first-time homeowners and getting to make that, up until that point, probably the biggest financial decision that they've ever made, go as painlessly as possible and help them get into their dream home. So awesome. I'm also excited to be here.
Fantastic. Can you share your handles real quick on Instagram?
I am the Dream Planner. So you can follow me on Instagram and X,
Twitter, whatever they're calling it. Yeah.
I am not on X anymore, but my Instagram handle is mortgage.miss.tessa.
Perfect. So to get started, we're going to start off with just some basic softballs, get everybody going. And Ariana, you kind of picked this one. Mm-hmm. Can I only buy a home if my credit score is perfect? And this kind of falls right into what you just said. You love educating and everything. So educate us a little bit. What's up with the credit side?
Absolutely. That's a question that I get from clients all the time. And the answer is no, you don't have to have perfect credit. And one of the reasons why I love working at NFM specifically, this is actually the first company that I've ever gotten to work with having loan programs with as low as a 500 credit score. And I think that's incredible. Now, would I recommend purchasing a house with a 500 credit score? No.
Sure.
Not necessarily. So everybody's situation is different. And of course, the higher your credit score, the more opportunities and the better options you'll have available to you. I would suggest working on getting your finances in order and having a strong credit profile before making such a big decision or a big purchase. But absolutely, your credit does not have to be perfect. And like I said, it can be as low as a 500. We just have to figure out if we can make that work for you.
And a lot of those circumstances are based on that individual situation.
Absolutely.
You need reserve funds, 10% down.
Right.
So a lot of times people hear this stuff on social media and they think, oh my gosh, I can just do this. But
yeah, no.
Yeah, not quite. Not quite.
And it really just depends on their particular profile. Like I've had someone that had a 512 credit score, but they were able to add a cosigner that had a stronger credit score, and just the higher 600s, they were able to qualify with 10% down. I've had another person that had a 525, but they had to put down 25% because they didn't have a cosigner, but they were able to bring that to the table. So it worked out for them. And then, of course, you have a 680, you bring 0 to the table sometimes.
Yeah,
so, it just depends.
And I've also had a one-off kind of scenario where I had a client that had just gone through a nasty divorce. Mm-hmm. Their ex-spouse trashed their credit because everything was joint at the time and they stopped paying. But then they had just gotten bought out of the equity in the home. So they had a substantial down payment and they could bring, 15% to closing, but their credit score was trash. But for that particular buyer, being able to go down to 500 allowed them to go from owning a home to purchasing their own home and didn't have to rent in between.
That's amazing.
Mm-hmm.
A lot of times when I talk to first-time home buyers and they're asking these questions about credit score, down payment, I try and describe things as like a four-legged stool. That's what mortgage is. You have 4 legs: credit, assets, income, and collateral. Mm-hmm. Is the home worth it? Mm-hmm. you can sit on a wobbly stool if the other 3 legs are really strong.
Absolutely. Makes
So
perfect
when
sense.
you're lacking one of those things, like you said, finding the stronger credit score, or like you said, massive down payment from a settlement, those are all things that can help offset that perfect credit score, not
100%.
perfect credit score. So anything else you guys want to add to that? That was really good.
Yeah, my thing is just you can't not have both. You can't have poor credit and no money.
Yeah.
You can have a good amount of money and poor credit. You can have great credit and no money, but you can't not have both. And in a perfect world, you have both.
Right. Absolutely. So with that, I guess like home ownership has really become difficult the last 5 years, coming out of COVID and everything. You guys coming into your 6th years or going past that, now you're kind of in grizzled vet territory. You're not like the younger people in the room.
Right.
After doing all the transactions that you've done, what's the one piece of advice, I want to start with Tessa, that you would give somebody starting out that just hasn't done this? They're the first person in their family that's owned a home or tried to own a home. What, you meet them in a cocktail bar, what are you telling them? What is that piece of advice you would give?
Yeah, I think that with first-time home buyers, the biggest thing is that they don't know what they don't know. And the biggest mistake that you can make as a first-time home buyer is waiting to talk to a lender until you feel like you're ready. But your lender is not just there to help you get pre-approved and once you're in contract, they're there to help you every step of the way and use somebody that has years of knowledge and expertise and experience to help you along the way, whether that is you need to work on your credit a little bit, or maybe you need a co-signer, maybe you have to save a little bit more. But until you have that conversation, sometimes I run into the situation where first-time homebuyers end up doing things that are not productive and they're not getting them any closer to being a homeowner, and they end up spending a lot of time and money doing that. So that's when they can kind of start to feel like they're spinning their tires a little bit and they're like, my credit's not improving, or, whatever. So my biggest piece of advice is actually talk to a professional before you think you're ready. There's nothing to be ashamed of. There's nothing to be embarrassed about. We're here to help you, even if that takes a few tweaks before you're actually ready to get pre-approved.
Yeah. I had a gentleman I pre-approved in April of 2021, and he closed on his home May of 2024.
Amazing.
So
Take some time.
It does. It does. How about you? What, your side of the table coming in, you both have different experiences. What does that conversation look like for you with a new buyer coming in?
Yeah, absolutely. My advice is to understand your personal budget. Stop worrying about what everybody else is buying and what their mortgage payment is and what their rate is. Understand what you can afford. And I always tell people, we're going to discuss your maximum purchase power. I can tell you qualify for a $500,000 house. Are you comfortable with a $4,000 mortgage? So it's not about what your pre-approval amount is, it's what your personal budget is. So really discussing what those numbers look like and making sure that my client feels comfortable, because there is a such thing as being house poor, and we want to make sure that you're purchasing, a home and building wealth.
Yeah. What you qualify for and what you're comfortable with.
2 completely different things.
Very often separate numbers. And you hit on something in kind of your overview, and I'm going to kind of skip to it. What do people need to expect to provide to get pre-approved? Because I could go on whatever.com and get a pre-approval letter. Yeah, right. Sent to me, but it says pre-approval on there.
That's crazy. Lies.
and so why is that? What do people need if they're trying to put a game plan together, even if they're 6 months, a year down the road? What do they need to be prepared to provide to get the best results and the best plan? And go ahead.
Yeah. So your financial documents, a lot of people sadly don't know the difference between a W-2 or a tax return or a tax transcript, or, obviously they know what a pay stub is, but they may not know how they get paid.
They may not know that they get pay stubs.
Right. Seriously.
Yeah.
So, and no shame, because, we weren't taught this in schools.
Yeah.
A lot of the time, this is the first conversation as a grown adult.
Very good point.
That I'm educating you on where you can get your tax returns and, things like that. So just understanding, where those documents may be. And, we're here to coach you if you don't know that answer. But just understanding, kind of just having your finances in order, knowing where, those important documents are.
And same thing goes for your assets also. You're probably going to have to provide at least 30 to 60 days of bank statements. Also knowing all of the other liquid assets that you have. Do you have a 401k? What's your vested balance? What are those tools that are in your toolbox so that you're ready to answer those questions when you talk to your lender?
I also think it's interesting that a lot of people say, I think that it's interesting a lot of people, and you can be a private person, but so many people don't want their job to know that they're purchasing a home. We're going to have to contact them.
Yeah.
So you're
100%.
going to have to tell, if you don't want to tell your boss, you might hate your boss and he doesn't need to know that you're buying a house, but let HR know that we're going to reach out for verification of employment, or that might hold you up.
Yeah.
So, you really can't be scared to, let us look into your finances.
Yeah. I think that's really important because so many people are hesitant. So, like we talked kind of broadly, I get a lot of questions of, can I spend money while I'm like getting pre-approved? Yeah, right. Like, so like talk to me.
You can still get your groceries. You can get your gas.
Yeah. So let's say you have somebody and they're concerned about spending money. They're very tight on funds. What does that conversation look like for you guys? Like, are they allowed to make a big purchase in an emergency? Are they allowed to open new credit?
My rule of thumb is talk to me first. If it's anything outside of your daily spending, like groceries, gas, insurance, the things that are your normal monthly expenses, if there's anything outside of that you are buying, co-signing for, having your credit run for any reason, the answer is not a blanket statement no across the board, but let's talk about it first before you do it.
I love that you said that because that's very important.
Everybody's finances are different, so it really does depend. But I do emphasize that once we pre-approve you, I'm basing this off of your finances not changing. So whether it changes for the better or for worse, like you said, let me know so that we can, reevaluate, what that pre-approval looks like. But if you're just doing your normal day-to-day, that shouldn't negatively impact anything. If you decide to, like you said, pull your credit, purchase something new, that is going to impact, what we had previously discussed.
And you mentioned impact, and one of the myths that I want to talk about is, does opening new credit destroy your pre-approval?
Not destroy in some cases, but it can. I've had people literally at the final hour purchase a car with a $1,400 payment.
Yep.
That killed the deal. So, maybe not do that. But, like you said, go grocery shopping. If your car, or if your tire busts, get a new tire.
Yeah.
But if you are short funds to close, have the conversation first, because as professionals, we should have emphasized, where they are and how much wiggle room we have. Yeah. And so, not everyone's going to listen to you, but you should.
Yeah. Well, and I think that goes back to Tessa's point about talking to your professionals. Like, if you have a tire that you need, hey, don't open new credit. If you have existing cards, use those. We can work around that, you know. And one thing I hear a ton, and it drives me nuts, is, we check your credit multiple times during the process.
No.
You take one credit inquiry, and now there's debt updates and there's debt notifications to make sure, but you're only usually taking one inquiry within that 90 to 120 day period for that. So I think that's important to let people know as well.
And it's extremely realistic for you to be able to find a home you love within 4 months. Yeah. And so technically, as long as your finances don't drastically change within, like you said, 90 to 120 days, which is approximately 4 months, you should be good. And we're not going to continue to keep checking your credit.
Yeah.
How long do you have for multiple mortgage lenders to pull your credit? We have not talked about this, so I want to hear this. Yeah.
45 days.
Yeah, it's 45. I usually tell people within the same month.
Yeah.
Because
just to be safe.
To be safe,
Yeah.
because I think that there is a little caveat that if you do it in the next month, but who knows?
Yeah, I know. So this is just my little nerd brain. The CFPB.gov, you can go there. The FAQ section, it's the third or fourth question, and they clarify that it's 45 days.
He
so
definitely knows.
Anybody experiences 14 on theirs, which is ridiculous.
But that's what I tell people. So
yeah. So and it's safer. You want to get them closer,
right?
Because the longer you go, your balances can change, your scores can change.
Your score can change, but your inquiry isn't going to be multiplied.
Yes.
So I just tell people it could look different.
And for people that are concerned about the inquiry, that hit only lasts on your credit for 120 days and then it falls off. It's like it never happened. So let's say that your credit was a 750. and then it drops to a 745. After 120 days, your credit's going to go back up to 750. There will be zero impact on your long-term score.
I tell people that for the most part too. You basically, get them back. You get those points back. And if you find a house within 4 months, you don't have to worry about doing it again.
Yeah. And it just depends on how, I don't want to say egregious people can be, but like if you're getting a bunch of inquiries, it's going to hurt you more and more and more. If you get limited ones in a certain amount of time, it bounces back.
Right.
So,
Yeah.
No, that was great. All right, let me jump ahead
Side
here.
note to that real quick for the shopping window. That does not mean that you can go open new credit cards or buy a boat or buy a car.
Mortgage
that is
specific.
specifically
Mortgage.
only for mortgages. So
Yes.
it's not a free reign to go open new debt.
Right.
Kind of on the same, since we're talking credit, I just wanted to take a second because like student loans are something that comes up a lot too. And you can buy, student loans. If they're in deferment, we still have to count a payment. Sometimes it's 0.5%. Sometimes it's 1%. Sometimes it's based off your income-based repayment plan. But if you haven't checked your credit score recently or you haven't checked your student loans recently, they did restart the collections. And if you were in deferment or in a dispute of any kind, they may have reported late. So that we can't really overcome if that happens. So just kind of check that. I wanted to make a note of that.
If you have any debt, you should have wherever you owe debt, like the contact information for yourself, mailing address and everything should be accurate. Because a lot of people say, well, I had no idea. Well, you knew you went to school. You knew you had loans. Yeah, you moved. You might not be getting the mail anymore, but they notified you.
Yeah.
Yes.
They notified us all.
Yeah.
Legally.
Yeah.
Comedian Ron White quoted a judge and said, "Ignorance of the law is not an excuse," as he was getting arrested. So it's same kind of thing. Same kind of thing. Kind of just again to jump ahead, we talked a ton on credit and thank you guys for sharing that. I want to jump because rates are improving and I get the refi question a lot. A lot of people think you can maybe only capitalize in certain windows, in certain time frames. So I want to start with an easy one. How many times can you refinance?
To infinity and beyond.
As many times as you'd like.
So as many times as you qualify.
Right. But so like there are things that are protections there because you have to recoup that within 48 months or there has to be a tangible benefit there.
Right.
So not unlimited, but based on the market. Right.
Yeah.
And then like so talk to me about how you guys handle the cost of a refinance. Like everybody hears like no cost refinance, all these things, it's free, blah, blah, blah. Like what is really going on? Let's kind of talk and help people understand what refinancing is so they know what to look out for in the coming months.
Kind of in the simplest way to think about a refinance is that your mortgage that you have right now is getting paid off in full. It's like it doesn't exist anymore. You get a brand new one to replace it. So with that, you get a whole new set of decisions that you get to make on what the interest rate is, your mortgage insurance, any of those terms that you originally agreed to no longer apply on that future refinance. What I really hone in on as far as the cost goes is the biggest thing that you want to keep an eye on recouping is going to be your title fees. Anytime that you're paying off a lien and recording a new one, there's going to be title fees that are included in that. So we compare that to how much are we lowering your interest rate? How much are we saving you monthly? Are we shortening your term? And does that benefit then outweigh the cost of incurring those title fees? You can pay those out of pocket if you'd like to. If you don't want to pay interest over the long term, we can, in most cases, roll them into your loan as well, so you don't have to bring them out of pocket with you. But there, even within the subcategory of a refinance, there are infinite decisions that you can make to make sure it's exactly what you want for more of the long term. You know, when you bought your house, this is what mortgage is going to fit your goals at the time that you buy your home. When you refinance, it's looking a little bit further down the line is, what is going to be more of our long-term goals. And
you mentioned roll in. I just want to clarify. So when they're paying off the mortgage, if the title fees are $2,000, your loan amount goes up by $2,000 to roll them into the mortgage and kind of go encompassing that. So title fees are definitely one. Great explanation on kind of going through that. Anything to add as far as the fees?
Yeah, so when I'm explaining it to my client, for the most part, you're refinancing because you're working with a little bit of equity and you want to either tap into that equity, whether it is to cover your closing costs and or, pull out, being able to actually access the equity in your home. So depending on your particular situation, there will be fees involved, but most likely than not will those fees be covered by the net proceeds of the equity in your home. So you're not actually coming out of pocket for them, and only if it makes sense to move forward with that new loan would we, close.
And the one thing I think people are surprised on is the escrow side of things, property taxes and homeowners insurance.
Those aren't going away.
And they're not, and you have to set up a new escrow account, but it's kind of robbing Peter to pay Paul, because you're getting that back when that first mortgage, that one that you're paying off, is closing. You're getting that back, and you can put that towards the principal balance to lower it or whatever you decide to do.
And that shows on your mortgage statement or on your payoff. You can look at either one of them, and at any given time, you can see how much is in your escrow account. So if that's your concern, you can think of it as basically just kind of replacing your old escrow account with the new one that we're collecting for. But it's money that you have to pay anyway at the end of the day. It's for taxes and insurance.
So it's just like Tessa mentioned, like if you're getting rid of your old loan and that old loan had your escrow. So, you're going to get refunded the old loan, but you have to create a new one.
Yep. And that you want to be careful, because depending on when your property taxes are due, that's going to affect all that stuff. So I appreciate that, because, that's going to be coming up. Any other advice on like refinancing, or any questions or myths that you guys are thinking of that you want to bust real quick?
I would say, again, just check with your mortgage professional to see if it makes sense. Generally, if you're going to be able to, get your interest rate down at least 0.5% or more, it makes logical sense. Or if you have a decent amount of equity, everybody's situation is different. So just talk to your professional.
To kind of tag off of that, I think the biggest myth that I hear with interest rates is that at some point in time, somebody has told that homeowner, you should wait to refinance until you can lower your interest rate by X%. That percent doesn't really directly correlate to how beneficial the refinance is. So even if you're lowering your interest rate by, 0.5%, but you're shortening your term, or you're getting rid of your PMI, or, there's any number of things that can play into how beneficial a refinance is. You also don't have to extend your term back out to 30 years. I've had plenty of scenarios where we were able to lower the interest rate, keep the payment around where it was before, and actually shorten their term. So that's something that I hear concerns of is, well, I don't want to reset my mortgage to 30 years. You don't have to.
And that makes a lot of sense too, because even if you're increasing your interest rate, it might make sense for your financial situation. Like there have been plenty of times where we've increased the rate, but we've done a debt consolidation. So you have $50,000 worth of credit cards on 27% interest. We eliminate that. You no longer have that payment. Your monthly expenses are the same or less, even with a slightly higher interest rate sometimes. So that is a really good nugget.
Absolutely.
It's amazing. People will balk at a 6.5% rate, but they'll go buy a television with a 27% interest rate on a credit card.
A television is crazy.
It's wild. It's wild. Priorities, depreciating asset, whatever. We've talked a little bit about costs. So like closing costs, a lot of myths around closing costs. And I mean, the real fact, we'll get into kind of the question of it, but the way you mentioned title fees are legal fees. Like they're flat fees. So one of my biggest pet peeves is like hearing the percentages that are used for like closing costs and things, because 2 to 3% on a $100,000 home up in lovely Northeast Ohio, not really going to cover much. So
it's going to get you your appraisal.
Yeah, right. Well, more than the appraisal there. But so let's talk general closing costs. How do you guys talk to clients about closing costs? What are they? What do they need to look out for? Kind of go from there.
I think that a lot of buyers, they tend to use like your cash to close and your closing costs as interchangeable when they're not. I would not treat them as the same thing. A lot of what goes into your cash to close, and what a lot of buyers would say, what are your closing costs? Well, they're not all costs. They're not all fees. Just like you mentioned title, those are legal fees. We don't get any money out of that.
It's based on the title company.
It's based off of the title company, which is picked by somebody that is not your lender typically. There's also a number of other things that play into that, one of them being your homeowner's insurance. So there's typically 12 months of homeowner's insurance, your annual premiums collected at closing. That's something that you would have to pay regardless of whether or not you finance your home. So even if you're buying it in cash, it's still going to be, involved. Same with title fees. So when we think about your cash to close, or what a lot of people call closing costs, are not necessarily all costs and fees. It's just kind of things that are included in what it takes to buy a home, you know?
It's a very general question, and it really is going to boil down to not only the state, but the city, county that you live in, you know, sometimes, or purchase in. Sometimes you have to have attorney fees, but, you know, depending on the state. And so we do try to be as general or conservative as possible so that you don't have like payment shock or completely unaware of what it might be. But it's going to depend on so many factors like the purchase price, the area, the house itself, the taxes. So I do personally generally say, you know, anywhere between 2 to 4%. But also factoring in that, you know, depending on your loan program, those could be, you know, completely covered by the seller. And I have several deals in my pipeline right now that are being negotiated to where they aren't coming out of pocket for those costs. We'll still discuss them and they still exist. But everybody's situation is so different. But I'd say in general, they're usually between.
You say the 4. So like a lot of people say 2 to 3.
Yeah,
But
I usually say 2
the
to 4.
4%, and you
That's more
pointed out,
realistic.
like you'll see a loan estimate and everybody gets scared of the big number because
oh my
it says
gosh.
closing costs and it'll say 8, 9, 10, 11 grand, whatever it is.
Yeah.
But that is not just your cost, like you said. I like to tell people when we're looking at a loan estimate, the left side is your cost, the right side your bills.
Okay.
They don't change.
Correlate,
they
right.
are what they are
100%.
everywhere
That's a great
you
way to
go.
explain it.
It doesn't matter. The left side is what your lender, you know, your title company, your appraisal, and all those things cost. So to your point, $4 grand, $5 grand, $6 grand for closing cost is probably pretty accurate.
general.
But you're also going to have your prepaid items and your other things on top of that.
Yeah,
that you
so
need
your
to be
closing costs might say a much higher number than, to your point, what you're actually bringing as cash to close.
Yeah.
So those are two different sections.
Yeah. And you mentioned asking the seller to pay for that. That's probably my favorite thing about the buying market from now until the end of the year is that buyers have a lot more negotiation power. So if you're buying in the heat of busy season and you're competing against 5+ other offers, that's something you're not going to have the opportunity to do, is ask the seller to cover those. So, you know, you hear a lot of buyers talk about getting a good deal. You know, what does that really mean? But if you're looking for your costs to be covered and looking for the seller to chip into that, this is definitely the time to do that when a lot of other buyers are not buying because kids just went back to school. We're coming up on holiday season and it's not a popular time to be buying, especially in this part of the country.
Nobody likes to move in the winter.
No.
Yeah, I love having the conversation of, you know, especially depending on the value of the home. Of course, it has to appraise for, you know, all the stars to align. But a lot of the times people don't realize that increasing your purchase price or the offer by $5,000 is only going to impact your payment by what, $30 sometimes. So let's say that we do realize that your closing cost for this particular home will be about $5,000 or $6,000, and the house is $300,000. Offer $305,000. You're still comfortable with that payment, and then you're not coming $5,000 or $6,000 out of pocket, and you know that's my favorite solution.
That honestly plays into my favorite myth, which is I hate when I see a sales price get lowered
By $5,000.
and not get a credit. So I just want to take a second and run that math. So 30 to 50 bucks per month or $5 grand in your pocket
Out of
right
pocket.
now.
That could furnish your whole home.
And if you run the break evens, which I have, 14 to 16 years every single time, average lifespan of a mortgage, not living in the home, but of a mortgage is 5 to 7 years. So
Get them seller credits.
always, 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 like do not lower your sales price in a negotiation. Ask for seller credits first and then lower. And
Absolutely.
that is something I'll die on. I'll argue with anybody out there that wants to argue with me.
Me too. A lot of people too will submit the offer and just say, "Oh, we'll ask for seller credits after the inspection." What if the inspection comes back peachy keen?
Yeah.
And also, you sign a contract as is, so the seller doesn't have to renegotiate with you. So it's so important to just ask for everything you can up front, especially if you're in a situation where there's not a ton of offers, the home's been on the market, the seller is motivated. Like make an offer that works in your favor.
You don't get what you don't ask for.
Closed mouths don't get fed.
I love that. I love that.
I think that is probably one of the myths that is one of my biggest pet peeves is when you hear somebody talking about getting a good deal. And it's something that somebody has told them at some point in time, you know, whether it be their uncle or somebody that has bought a home has pressed to them that in order to get the best deal, you have to get the lowest purchase price, which is definitely not always the case. depending on your buyer's specific goals. The purchase price, or the asking price, may or may not, be what the house is valued at. Sometimes if they do price reductions, you have to look at the comps to see what the true value of the home is. If it's a house that is worth $280,000 and it's listed for $260,000, you're already getting a great deal on the purchase price of the home. At that point, what's really the benefit to offering $5,000 under when you could potentially, to your point, ask for $5,000 in closing costs to be paid for by the seller. And I think that's a way better deal.
The seller really just cares about their net profit a lot of the time. So make it work in your favor.
Yep. And I also just want to add, when you lower your sales price, you lower a comp that's in your community and you hurt your future values.
Look what you're doing to your neighbors.
I just never understand it.
Yeah.
So I want to get into just some rapid fire because we've a ton of great stuff.
Yeah.
Thank you guys. One question I get as we're kind of getting to the end of the process is biweekly payments, bi-monthly payments. How do I set that up? Talk to me about how you guys coach about that. Is it really beneficial? Get into the spreadsheet in a second. Let's handle, because I want to hear the commentary first. So, do bi-monthly payments really make sense?
Absolutely. And I believe, I don't have a chart, but I believe it will equate to at least one full payment extra that year. And I also don't know the math, but it is going to shave off a few years and tens of thousands of dollars in interest in the long run, especially if you keep that mortgage for the duration of that time.
How much? So, take us through the numbers.
Yeah. So, here's an example of how much it would actually save you. So on a $300,000 loan at 6.5%, 30-year term, if you made bi-weekly payments at the same amount that you would be paying monthly for your regular mortgage payment, you just split it up into every 2 weeks instead of once a month. You're exactly right. That would be one extra payment every year. You'd be making 26 payments over the year. On that $300,000 purchase price, that would save you $88,000 in interest over the life of the loan.
Whoa.
And that would shorten your term down to 289 months, which is just under 25 years. I think it's about 24 years.
Yeah, I said about 5.
So it would shave time off of your mortgage as well. So for almost no difference as far as, what your month-to-month cash flow would look like in paying your mortgage, it would save you a ton in interest over the life of the loan.
Wow. That's a bigger amount than I was thinking.
Yeah.
That's awesome.
It's so the 26 payments, 52 weeks in a year. A lot of people get confused when they get paid biweekly. They think, I get 24. It's 26 pays. That's why you have, 2 months where you get 3 paychecks or whatever.
The 5-week months.
Yeah. So right, exactly. Yeah, you get a little extra there.
Right.
So, and it helps with monthly cash flow too if you set it up that way. Now, I do coach a lot of people because sometimes you have to make a payment or a half payment ahead.
Right.
So you stay.
Mm-hmm.
So that's one thing you have to be cognizant of is just making sure that you're ahead of that.
Mm-hmm.
But to your point, I personally do that as well, and
That's awesome.
it's a good thing.
I always coach my buyers to get one full payment ahead so that you're not always playing catch up and you're 2 weeks behind on your mortgage payment.
Yeah,
so get a full
absolutely.
payment ahead before you start to do that.
And then also communicating with your servicer to make sure that extra payment is going towards principal.
Yes.
And not just towards, the split of the escrow and principal.
Absolutely. A couple rapid fires I want to go in. Are first-time homebuyer programs worth it? What is the benefit of being a first-time homebuyer? Because I personally, and I'll get into this, I think it's oversold by our industry.
I agree.
Really?
I agree.
Well, I work with a lot of people that don't have money.
Well,
so-
I do a lot of down payment assistance aside.
Yeah.
Outside of that benefit,
Oh, yeah.
I don't think that there's any benefit.
The biggest
agree.
benefit is the affordability. So
Yes.
they can offer options for lower down payment requirements, down payment assistance. So if that's a concern, if you have 5+% that you were already planning on putting down, it's not really any different
It's not,
if you're a first-time home buyer.
Right. I talk to people all the time. They're like, well, I'm putting down 20%. What's the benefit of being a first-time buyer?
There isn't
Nothing
one.
for you. It's really only to your point, you may have the opportunity to put down 3% instead of 5% as a first-time buyer if you're going conventionally. But if you make under a certain income limit, there's programs that still allow you as a second-time buyer to put down 3%.
Mm-hmm.
So it's not as beneficial as people think for sure.
Yeah.
And real quick, just to add to that, you can still be a first-time homebuyer, even if you're not truly a first-time homebuyer.
Mm-hmm.
So if you have not owned property within the last 3 years, you kind of like reinstates like your first-time homebuyer eligibility again. So if you're someone that needs down payment assistance and you are renting right now, and it's been more than 3 years since you owned a home, you are eligible for all those down payment assistance programs again.
Mm-hmm. I was just talking to someone yesterday, and she was just like, well, I'm probably not going to qualify for any programs because I bought a house when I was 21. She's like 45 now. And I was just like, well, you're technically rebirthed the first time buyer. She was so excited. She was so excited. She's like, it seemed like she won the lotto. But in her situation, she's like, I'm not a first time buyer. I bought a house 25 years ago. And I'm like, you are.
You are.
So she was really excited about that.
And that's something I've had a few people recently that I've been able to do that with too. Yeah. And they're just like, oh my gosh. So
or it's just hit the 3 years.
Yeah.
As long as it's over the 3 years. And so for her benefit, she qualifies for the down payment assistance now.
Yep.
So, there are, programs that are for next home buyers, but usually have more benefit if you truly are a first time buyer and doing down payment assistance. But that's really the only benefit.
And I agree. I think, and I try and tell clients this, anytime you can bring your own funds, you're going to get yourself better terms.
Yes.
Like there's no free lunch.
Absolutely.
If the government gives you something, we all know the government's going to take it away.
We all know
So it's just kind of how it goes.
Effective immediately.
Yeah, pretty cool. Or they're going to come after you.
Yeah, seriously.
So
they're going to put a lien on your house.
And unfortunately, if you make a good amount of money, you might not get all these benefits too. So, you got to put that into consideration.
Yeah, a lot of people, qualify. And the average first-time home buyer was 38 in 2024. And so, like, a lot of those people are farther into their careers. They may be over those income caps and things like that.
I beat the statistics.
Yeah, that's exactly it. Last year, actually, more single women own homes than single men now, too. So
the future's female.
It's abundantly clear as I sit in this room. Anything, I guess let's kind of shift. Talk to me. You guys joked about this. You don't love talking about rates, but talk to me about interest rates. How often do rates change?
Every day, every hour, every minute.
I was going to say unless the market is closed, interest rates are changing.
So let's talk about the market because we take for granted what we know. So the market, what is dictating mortgage pricing?
I would say 10-year bond, or I guess the bond market in general. The bond market is
10-year treasury.
10-year treasury is what our interest rates closely follow. So there's hours that it's open. There's a clear open time, clear time the market closes every single day, federal
like
holidays.
The stock market.
Yeah, exactly. If the market is open, interest rates are actively changing.
Yeah. Do they move? So we hear that, and I want to quantify that for people because that can be scary, especially in a time of volatility and unsurety and things. How much do rates move in a given day? Obviously, very circumstantial, but are we talking? Yeah, so we're talking 1/8 of a point. Yeah. We're talking cost. We're not talking big jumps unless there are massive events.
Right.
Yeah. So if there's like a
pandemic,
it's
a great example.
I mean, Anyway, I'm not gonna go off on that deep end, but if there's a big market moving report that came out that day, and this is your specialty to talk about these things, but if there's an unemployment report that comes out, that might change volatility on a day-to-day basis. But I would say on the average given day, the interest rates are going to be pretty much the same throughout the day as what the market opened at. There's not going to be hardly any change.
Little ups, little downs.
And if there is something drastic, more than likely we're going to reach out to you. When you're actively looking for a home, we're in constant communication on a week-to-week, if not day-to-day basis. So if something significantly changed, your loan originator should be communicating that with you, just so that, especially if you're out there shopping at the very top of your budget and rates did, drastically change a little bit, or your program did change, we want to revisit that conversation of what that payment might look like and the closing costs.
Yeah.
And if it's still comfortable for you, go ahead, move forward.
So talk to me about when that becomes not a risk. Talk to me about rate lock. Because a lot of people, when we're talking at pre-approval, unless we clarify, a lot of people are assuming that's my rate, I'm moving in, whatever happens. So when does that not become an issue?
If we're at the pre-approval phase, I always, give payment ranges at that point. I make it very clear that their interest rate is not locked. Sometimes you can be looking.
So what does that mean? Not locked.
It means that your interest rate is changing with the market. So anytime the market shifts, your interest rate is going to shift as well. We want to make sure that that's not a surprise when the buyer goes into contract if that does change a little bit. And then we do lock your rate once you go into contract so that we can make sure that once you have signed on the dotted line, that nothing is going to change from that point to the closing table.
Yes, your rate is going to be associated with the address that you are purchasing. So, like Tessa said, up until you're under contract, there's really only a range that we can discuss, and you just want to make sure you're comfortable in that range.
Yeah. And I always say this to every buyer on the consultation: do not get married to your interest rate. It could take you weeks. It could take you months. I've had buyers take over a year. Yeah. The interest rate that you were originally pre-approved at could be very different from when you actually go into contract, but that's why it's so important to stay in constant communication with your loan officer and make sure that you never get disconnected.
And that's where, I'm sure a lot of loan officers do this, but our payment scenario systems, our offer support, things that help keep us in front of people. So when those things happen, we can run those payments again and have that conversation that you mentioned.
Yeah, absolutely. Might have to shift the, search a little bit, if you're no longer comfortable with where that shift was. Yeah. But, like Tessa said, don't marry the rate, date the rate, marry the home, fall in love with a house that you can afford.
Yes.
And understand that payment and that rate is temporary. Yeah. I think the average person refinances, 7 years over a 30-year span? So
7 years.
Come on.
So, and I think that's a great point. Yeah. And as we're wrapping up, my last myth is Fed rate cuts. So we've just talked about interest rates and them changing and everything. What happened after the last Fed meeting when they cut interest rates, guys?
Interest rates went up.
And did they go up a little bit?
They went up a lot.
Yeah, they did. And so when the Fed cuts rates, they're cutting short-term rates, right? So things like home equity lines, car loans, high-yield savings accounts, those are the things that are affected. How are you, because you mentioned, Billy Bob's uncle over there that's bought a house in 1985 and lived there for the entirety of his life on the bayou, right?
But he's the expert.
And so, how do you guys talk about Fed cuts? How do you prepare clients in this environment? And I'm happy to obviously jump in, but how do you guys handle this from your situation, and how are you guys having those conversations?
I try to dumb it down as much as possible. I don't want my clients being overwhelmed about that because again, just back to our past conversation, you may not have the prettiest, sexiest rate purchasing your home. That can always change. As long as you're comfortable with the payment and it fits within your budget, don't miss out on an opportunity of purchasing a home because the home is going to be worth more later and you can change your rate. So,
yeah. I always explain the Fed cutting rates as they're not cutting mortgage rates. They're cutting the rates that banks trade at. I frequently will point buyers in the direction of the 10-year treasury. So it's not coming from me. It's coming from, a third-party source that is not biased. So we can point to say, this is where the treasury was before the rate cut. This is what happened after the rate cut. And I always explain the treasury as it's not reactionary of what has already happened. It's predictive of what's going to happen. So if there's indicators that our economy is not doing well, that unemployment is high, those are all things that are going to, in real time, be impacting our mortgage industry interest rates. So when the Fed does what we expect them to do, we can expect that it's not really going to change interest rates.
And to that point, we know, as of this recording, I checked before we came in, there's a 92% chance of another Fed rate cut in October.
Ooh.
And rates are moving up.
Yep.
So don't let that be an indicator. And if rates improve, to your point, you can always capitalize down the line. Thank you guys. This went way smoother than I expected it to. Is there anything you guys want to add? Anything we didn't hit on?
Go Bucks.
Go Bucks. Yeah, absolutely.
Purchase real estate.
Yes. I heard a great quote, and I'll leave you guys with this. Rogers.
I got one more.
Oh.
We didn't talk about buying versus renting.
Oh, we don't have time. Oh, okay.
Okay.
Buying versus renting. No, so honestly, this is a good one to circle back to before we go into the wrap up. Is it always cheaper to buy than rent? And let's talk about what cheaper means too.
That was going to be my follow-up question is what does that mean?
So
cheap?
obviously this was one you wanted to answer. So take the lead on this one.
So I think when we talk about buying versus renting, that question in itself could be its own podcast. I could probably talk about that for an hour, but I think the number one biggest factor is wealth. The wealth gap between homeowners versus renters is as wide as it's ever been.
300,000+.
Yeah.
Oh my goodness.
Yeah.
A crazy stat is that 97% of wealth in the United States is held by homeowners. 3% is held by renters. And it's also the number one biggest wealth builder that you can invest in the country. So there's a graphic that Kyle and I both show to all of our home buyers really on every consultation. When we look at historically from 1980 until present, nationally, there have only been 6 years that home prices dropped annually. And 5 of them were the years that were around the 2008 housing crash.
2007 to 2011.
Yep. When we look at the S&P 500 in that same time period, there has been 10 years that it was negative. So when you compare that with the S&P, real estate actually outperforms it. Something that I tell first-time home buyers every single day is that your first house shouldn't be your dream house, but it gets your foot in the door and it gets you a piece of the pie. So that you can start building your wealth. You can start building your equity. One thing that I think is a little overused and something that I see on social media all the time is stop paying your landlord's mortgage. But it's true. When you're paying rent, you are paying for either the person or the company to build their wealth instead of your own.
And I want to talk real quick. Do you have anything to add before I move on?
Yeah, no, I think those are, very obvious, like great stats. I think that just finding a way to purchase real estate that is affordable for you in some way. I understand that the economy is not affordable right now, but just finding something that fits within your financial situation is only going to put you in a better place in the long run.
People try to time the market a lot. And I always say, if you can afford to stop renting, you should buy.
Absolutely.
And I want to quantify because I shared a stat on social media and I wrote it down because I wanted to share it during this conversation. So I'm glad you brought this back up. Pre-COVID and those first 2 years of COVID, they're an anomaly. Okay.
I'm part of that.
They are not. Yeah, right. Better be lucky than good. Timing the market versus time in the market.
I saw everybody buying a house. I was like, I'm not ready, but I'm buying it.
Right.
Like I don't want to be the last one on the boat.
I gotta
But to that point, though, in order for the market to return to 2019 affordability, home prices would need to decrease by 38%. From 2007 to 2011, the greatest collapse in history, it was a total of 26%. So it's still short of that.
Yeah.
Wages would need to spike by 60%.
Never happening.
Or rates would need to come down to 4.15, which over the last 25 years is 0.6 lower than the average, which is like 4.75, somewhere in there.
So you're telling me there's a chance?
I'm not saying it's impossible. Hey, the fallacy of waiting and everything, and you can look, and these are all verifiable facts, and I'm a very big source person. There has not been a 10-year gap where you could buy real estate and lose money based on appreciation. So
the only thing I wish I would have done is bought a bigger house with my 2%.
Yeah, right. Absolutely.
Because it's not going to happen again.
Absolutely.
You shouldn't wait to buy real estate. You should buy real estate and wait.
Stole my quote.
Absolutely.
That's Will Rogers. I encourage you to look him up, but that's my favorite quote right now with
I was
real
going
estate.
to ask who said that originally, and I was going to guess Kyle McCort.
No. Will Rogers, the Cherokee kid, said, don't wait and buy real estate and wait. And I mean, he was somebody of Cherokee descent, and during his time, that was not a favorable thing to be. And he rose to fame, and he built his entire portfolio out of real estate to help him and his family continue to go on. So
smart man.
I mean, it really comes to it. So thank you, ladies, very much. I appreciate the conversation.
Thank you, Kyle.
I appreciate the time, and that is all we got, guys. Thank you for listening.
Guys.